Absolutely. Here we go. Here we go. Waiting for more people to join us. We're going to be talking about something that you need to really comprehend. Okay? 15 more seconds. We really need to comprehend this. Yes, I do understand the times that we're in. Absolutely. I do understand that there's some volatility going on. All right. I do understand that there are banks that are now closing their lines of credit. All right. But I'm going to show you that you don't need to be concerned with that. Don't be concerned about other things. Okay. Be concerned with what you are going to do. And let me show you what you could do in the event of a line of credit going away. Okay. In the event that your bank goes away, in the event, it's not about other things. It's not about what the bank does. It's not about what your line of credit does. It's about what you do. Because the fact of the matter is, velocity banking works whether or not the banking system works. Okay, so let's go ahead and take a look at these two terms right now. Right? Then this one right here. The last one, I would say that a lot of people are familiar with. You're familiar with the interest rate part, right? You're familiar, well, because of the things, some certain things that are going on. Boy, that's a deep hole right there, Frederick. Hey, we appreciate you, man. But that's why, because of some of the things that are going on in the world right now, some investigations and different things. That's a great question. But yeah, do that research, man. You'll be surprised. Interest rate. We already know what that is, right? 6% interest rate. Sometimes it's talking about the mortgage. Sometimes it's talking about car loans, lines of credit. We are familiar with the interest rate. But can I submit this for your consideration? That we do not need to be as interested in the interest rate than we are with time and balance. We need to focus in, especially now, we need to focus in on time and balance. And then we need to realize what we can do to eliminate our debts even faster, utilizing, watch this, time and balance. Now, this is what I mean by that. Let's go ahead and say that you have a loan. We're going to go ahead and put borders around here. Okay, like that. Let's say you got a loan and you got a loan for $5,000. Let's just make it a round number, $10,000. Okay, $10,000. There are thousands of ways that you can pay off this loan. You can go by the bank's plan, okay, which your bank is going to tell you something like this. Okay, 10,000 at, let's say, 7%. Okay, and then we're going to go ahead and make you, Mr. Smith, pay, let's just say, and we're just pulling these numbers out of the blue here. We're going to make you pay $700 each month, and that's going to be your minimum payment is $700 each month. Well, you can pay it like that if you'd like. Okay, and let's just say that you are making the $5,000 monthly, and your expenses are $3,000, and so you have $2,000 worth of cash flow. Now, one gentleman, Marcus, was saying, CJ, I just take my cash flow and I put that cash flow towards my principal. Can you do that? Absolutely. Absolutely, you can do it. However, what are your thoughts on this method? Instead of taking your cash flow and making your cash flow work for someone else, hear me on this, please. You're taking your hard-earned cash flow and you're making it work for someone else because you're paying the loan. Why not have your income come to you, and then your expenses go to someone else. And then what's left inside of, let's just say, a line of credit is what's paying that line of credit down. In other words, you're going to go ahead and use a portion of that line of credit. And you're going to deploy that line of credit that you have. Let's just say your line of credit is 10,000, okay? That line of credit is 10,000, and you are using a portion of that line of credit to hammer down this number, okay? This is a loan. So let's say you say, you know what, I know it's $10,000, it's $700 each month, but I want to deploy $7,000 towards the principal, okay? $7,000 towards the principal. What is that going to bring it to? That's going to bring it to $3,000 at 7%. This is a static example, okay? So I know your lender's probably going to be different. This is a very static example, but the principal is still there, okay? How much interest did you save going from this number to this number? I would say that's a lot of interest saved, right? Right? That's a lot of interest saved. And so that's what it's about. It's using time and balance for us instead of against us. So as we use our line of credit, now look, you don't have to use the line of credit to do velocity banking. All right? It's just that there's a lot of questions on it. That's okay. All right? Is that all right? So we're just going to address it right now. Because people think that when you use a line of credit and you're paying your loan with a line of credit, well, you have two debts. However, one banking tool is an open-ended, and then the other banking tool, which is the loan, is a closed-ended interest product, okay? Meaning it only goes one way, whoosh, one way. While the line of credit can go two ways. You can pay and borrow, and pay and borrow, and pay and borrow. Does that make sense? So as you're placing that $7,000 towards that principal, you don't have to worry about any income, any minimum payment for your credit card, because you're using your credit card or your line of credit as your new checking account. Okay? And as the money comes in, $5,000, and then the money goes out, $3,000, what's paying that line of credit off? The $2,000 that's left. And oh, by the way, you'll be paying the line of credit off in how many months? Let's go ahead and do the math. Let's do the math. Let's go ahead and do the math. I'll do the math right here. We already know that our focus today is time and balance, not necessarily the interest rate. I need you guys to stop worrying. Stop worrying about the interest rate, because that's not as important. Notice, I didn't say it wasn't important. I'm just saying it's not as important as time and balance. Okay? And these are things that, of course, we'll show you in the class, right? We go to a deep dive on the class, and we do that right here. Okay? We take a deep dive into that, as well as give you your own plan. Now, the thing that I like about when people sign up for the class is that they no longer have any questions. Especially when they get their proposed plan. They get their proposed plan, and now they're like, oh, I see it right in front of me. And it just clicks. For many of them, it clicks just like that. So bit.ly/VEL, capital BAN as in November, the number 2, right? And then they get their free proposed plan. They're out of their mortgages. They're out of their auto loans. They're out of their personal loans. They're out of their student loans in less than 30 years, less than 50 years. I knew one fella, he had a 50-year plan. The bank put this fella on a 50-year plan, greatest nothing. Oh, you know what? I know why you're saying that. It's okay. It's all right. Yeah, it seems like it, doesn't it? It seems like it. But it's way more. It is way more. That's a good comment though. Good comment. Thank you so much. Do you see what I mean? And so it's so much more than meets the eye. So if you're looking to actually implement this, right, you don't have to look any further, right? That's where you'll go. You'll get the class. Not only that, you'll get my help, and it's not going to be one of my team members, right? It's going to be my help. And we'll go ahead and put you through to that proposed plan as well. And so we have the $7,000, right? But we want to look at this. We want to look at the $5,000 in income. And of course, this can be your number. So go ahead and make it personal. Go ahead and make it personal to you. Go ahead and put 4,000. Go ahead and put 10,000. Whatever your number is, I want you to follow me on this. Okay. Then we have 3,000. Okay. In expenses. That will leave us with 2,000 in cash flow. Does that make sense? $2,000 in cash flow. This is the number that is going to be paying your line of credit off. We do not ever want to pay a loan off with that. We don't want to pay our principal off with this, with the cash flow. No, thank you. Okay? We want to make sure that we are paying down our line of credit. We want to make sure that if we don't have a line of credit, that that part is staying in our checking account. Okay? Now, of course, if you are not there, if you are not yet cash flowing, if you're not yet cash flowing and you are still at zero or even negative cash flow, that's okay. We still have a plan for you. It's 99, right? Listen, we want you to know something. We're not going for 99%. We're going for 100%. All paid off. Everything that you have paid off. Your mortgage paid off. Your loan paid off. Your auto loan paid off. That's what we want to do, okay? So that's what we're focusing on right now. That's what the class is all about. That's what your proposed plan will be all about as well. It'll be about paying off everything that you have. We'll give you a plan. You will work with us in order to bring that plan to pass. Does that make sense? Okay, so let's go ahead and continue on with our example because we still have $3,000, okay? $3,000 left on our 7% loan. But we did something. We deployed from our line of credit, okay? So now we have a $7,000 balance on our line of credit. And that's where people say, well, CJC, that's what I'm talking about. We have two debts now. But watch this, okay? That $7,000 balance is going to disappear very quickly. Why? Because that $2,000 is still left in the line of credit. Oh. You know, when you've been in bondage for so long and you finally see the air, right? You finally get to go outside. It feels real good. Some people laugh, some people cry for joy. Okay, watch this. So this is your balance on your line of credit. And this is your cash flow here that stays inside of your line of credit. So we're going to do this. We're going to erase these zeros here. I like that. I remember the first time I came across that. Man, you just erase the zeros out. It was so easy for me. Okay. And then we want to divide these numbers right here. 7 divided by 2. What is that? 3.5? That's 3.5, isn't it? 3.5 months You just got rid of $7,000 balance simply by using your line of credit as your new checking account. Because yes, you had to deploy that $7,000 towards that loan, okay? But while you did that, you decreased significantly the interest that you would be paying, okay? Now watch this, okay? 10,000. And I know, guys, I'm gonna stop with the math in a little bit, but I just wanted you to see this because I know some of you are getting nervous. Oh no, he's not gonna do any calculations, is he? Right. But look at this, okay? 10,000 multiplied by 7%, okay? And you'll see that that is a number that you probably wouldn't want to pay, okay? Let's just go ahead and just be honest about it. So that's, what is that? 2, then we do 4, right? And then we just move them over like this, okay? So that's $700 in interest. $700 in interest that you're paying when you have that $10,000 loan. And for some lenders, it's even more. So that's $700. However, when you reduce it to 3,000, okay? When you reduce this number to 3,000, what is it going to say then? How much are you paying out then? Huh? Is that right? Check my math, somebody. Is that right? $210? Is it $210? You want me to do the long division? You guys go away with the long division, wouldn't it? Listen, $210 versus what we have, 700. Which one would you rather pay? Which one would you rather pay? That's what it boils down to. Okay? So whether this was $210 or $21, right? It's still less. It's still less than the 700. Okay? It's still less than the 700. So what I want you to do is this. I want you to picture what you would do with the difference between the 700 and the 210. Okay? Picture what you would do with the difference. Because that difference is coming to you. Does that make sense? What is that? 700 minus the 210. And the reason why I want you to picture this is because that's what banks do. Banks picture it. Why not you? Why not you picture it? Picture what you would do with that interest. What would you do with it? And we have a proposed plan for you so that you can have an idea of what to do with it. Okay? That's what we want you to do. We want you to be in control. We don't want anybody else in control. We want you in control. Hasn't somebody else been in control long enough? Okay? And so please, please, please start thinking that way. Don't just look at the interest rates. Don't just look at the interest rates, okay? Look at what the time and the balance is for these loans. That's what you're going to be looking at, time and balance. Because the closer you can pay your debts off on the statement date instead of the payment due date, the less interest will be charged on that average daily balance. Huh? Now, if you want to think like, have that abundance mindset, then we have to start thinking in terms of how can I make time and money work for me? How can I make time and balance work for me. Because one thing's for sure, the banks are definitely thinking that way. They even have a whole system set up, right? And that's why we have a system set up as well to make sure not only that you know about velocity banking, but now you have a plan to put you on the road to getting into financial freedom as soon as possible. All right? So listen, you can bring any questions. What are the usual requirements for a line of credit? Man, I appreciate that question. The usual requirements for a line of credit is they're going to go ahead and check your credit score, of course. And then, of course, they're going to look inside of your bank account to see what the flow of money is. And then they're going to be determining which amount you should get. Okay. And that's the powerful thing about using a line of credit is that no matter how small it is, you can pay off giant loans, right? I'll say it like this. You can pay off Goliath loans with David lines of credit. You can pay off Goliath loans with a David line of credit. I knew a woman, fixed income, very small income and I still know her. She's still alive. She's a landscape. I think she's in her 70s, maybe 80s, early 80s now. And she told me, CJ, I was using velocity banking before I even knew what it was. I've stacked up $80,000 in lines of credit, and it's growing. I have a fixed income of 1,700, I believe she said, a month, and it's been that way for a while. Okay, 80 grand in lines of credit. It's a beautiful thing, and these are real stories, folks. People getting $35,000 and they didn't even know that this was available to them. Lines of credit. What does that do for you though? It doesn't just give you more money. What it does is it actually lowers your credit utilization ratio as well. How many know about credit utilization ratio? So Sway, that's one of the usual requirements for a line of credit, and they are actually it does vary from bank to bank, but usually that's what it is. Very good question, King Malice. When paying on the statement date, cause late payments due to paying after the due date, and that's why we would actually go ahead and make sure that the statement date is before that due date. Very good question, King Malice. And so that's what we have here, right? That's what we have here is lines of credit that are small, but defeating loans that are just humongous. Now, some of you are like, well, I'm not really a line of credit guy. So, and that's good. And that's good. You know why? Because you'll still get a plan for you. And you'll see the amount that you'll need to pay on each loan, on each line of credit to get you out of that and into assets so that those assets can start paying you, so that those assets can start paying your car. I have or had 3 cars paid off. I gave one to my friend because he had to go up to Casa Grande on a daily basis. What about a 2.5 hour drive? I was like, hey man, here you go. He was like, what in the world? He only had paid like, I think $42, $45 for the registration here in Arizona, but things like that, you know what I mean? When you're flowing with that line of credit, you know how to use it. You don't have to be a trillionaire, you don't have to be a billionaire to use these methods, and that's the great thing about it, right? And so when you're looking at 73, like the example that we had yesterday, when you're looking at $73,000, and then you're looking at, let's say 10 or 12%, there you go, 12% in interest, and it doesn't matter if this was 12% or even 40%. What does matter? What does matter is this, okay? What matters is what you're going to do to this number right here. This number matters. Some want to put their cash flow to that number, and that's good. And some want to utilize their lines of credit. They want to utilize their savings so that this number doesn't have to haunt them, okay, throughout the day, throughout the night. So they use their savings to get rid of this number. And some are like, well, wait a minute, why in the world would you use your savings? Well, one of the reasons, and I'm not saying for you to do this, okay, I'd have to take a look at everything that's going on, to give you a customized proposed plan, right? So I'm definitely not saying to get rid of your savings, but one of the reasons you would is because what if your savings is not giving you the return that you desire, right? If it's earning you a 0.4% interest or 0.04% interest, okay, and that money's not going anywhere, what it's doing is it's sinking, right? Because of inflation, because of taxes and different things like that. You still have to add that onto tax forms and different things. So let's go ahead and see, right? Let's go ahead and see if the savings, right, that you have, let's say is $12,000, $12,000 in savings, would you fare better keeping that savings account? Or would you fare better placing some of that savings towards the principal of your loan? That's $73,000. Now, of course, if you have multiple loans, right, that's different, right? And we'll actually go through a scenario in which we'll be utilizing a tool called cash flow index number. Cash flow index number. I know some of you were like, man, what is he doing? You know, come on, CJ, it's 3,000 multiplied by 7%. Yeah, man. Well, when I go through these numbers, it's so unbelievable. It's so unbelievable. I have to do a double take. I can't believe that they're getting away with this stuff. But I digress. And so $12,000 is making, let's say, 0.4% inside of your savings account versus getting rid of a loan that's costing you 12%. Okay, 12%. Which one should you do? If you find yourself in that scenario, this is what I suggest. Let's go ahead and do the numbers. And then don't be convinced by me. Be convinced by the numbers. Okay? All right, so let's go ahead and take 73,000 at 12%. Let's say, I'm going to go ahead and have my calculator here. How's that sound? Huh? Is that okay? Let's take 73,000 and multiply it by 12%. Okay, that's $8,760. And let's just say that's the APR, that's annual. Okay, $8,760. That's interest. Okay. Now, watch this. That's an interest, right? Okay, that's an interest. But now I want you to deploy $6,000 from your $12,000 savings account. And I want you to hammer this principal. Let's hammer that principal. So let's go ahead and take, and you'll do this with me, it's okay, 73,000 minus the 6,000. That'll be 67,000. Let's see if this is something that you would be okay with. Okay, we got 67,000 at the 12%. Okay, now how much is that annually? How much is that annually? Let's go ahead and do it. Multiplied by 0.12, because we're talking about 12% here. That's $8,040. Now, this may be a big whoop to you, right? Okay, well, whoop-de-doo, CJ. I mean, I deployed $6,000 to get rid of, what is that, 600 something interest. So let's see. Let's go ahead and do the math here so we can have that for you. Okay, so that's $720, right? Annually that you've saved. Okay? So essentially, and this is one way you can look at it, okay? How much has your $12,000 netted you so far? And this is the difference between cash flow and accumulation mindsets, right? Not that one is better than the other. You know, one is better than the other in different circumstances and at different times. Can't make a blanket statement on that, okay? But if you're looking at it this way, I think you would be persuaded by the numbers. So let's go ahead and get out of the picture, look at the numbers. If you're looking at $73,000 and you already have the $12,000 savings account, and you decide to pull $6,000 and hammer that $73,000 principal, you're going to end up with the $67,000. Okay. And we're not getting into the weeds here because we want you to get the concept and the principle. Okay. $67,000 at 12% is $8,040 versus the $8,760 a year that you would be charged with is $73,000. Now, let's keep in mind that, of course, you will be paying that loan down each month. But like I said, for easy math, let's go ahead and take these two, right? Now, the difference between these two is $720 that goes in your pocket now, not the bank's. How much does your $12,000 investment give you now versus what it could give you then? Does that make sense? Let's go ahead and have you look at it again. How much does your $12,000 net you with your 0.4% interest? Okay. With your 0.4% interest, let's just say it was 5%, guys. There's some good savings accounts now. Get with me. I can show you. We'll show you some. You can actually Google it too. Let's just say it's 5% now. Okay. You say, CJ, but I don't want to pay all those fees. Okay. All right. Yeah, because you got to add that in. So let's say your $12,000 investment in your savings account was actually earning 5% a year. We can do that math. Is that fair to say? Because there's some banks that are online that are absolutely great because they don't have that overhead of physical banks. So 12,000 multiplied by 0.05. Okay. So annually, it's giving you $600. Not wild? It's unbelievable, huh? $600, and that's annually. Meanwhile, you're making $720 with $6,000. So surely, I should have done this. I should have said $6,000. Okay, let's make it even. Great catch. Okay, $6,000. So $6,000 multiplied by 0.05 is 300. It's 300. So you made 300 that year, keeping your savings, right, account with the $6,000 there versus making $720 with the $6,000 here. That's why they say those that do not understand interest pay it versus those that understand interest, they earn it. Does that make sense? Because that same $6,000 is earning $300 for that year in that bank, which is not too bad. You know, that's not bad at all. 5%, especially in this environment, versus that $6,000 coming over here, paying off this loan, okay, helping to pay off this loan, and then netting you $720. So that $720 goes into your pocket versus the banks. Oh, and by the way, do banks like it when you pay loans like this? You're paying the principal on it and you're being responsible, right? As long as you're not too responsible, right? And paying it off in 1 month. Do they like that? Do the credit agencies, do they like that? The credit reporting agencies, do they like to see that? Does your score get affected when you have a plan like this? Okay? If you don't have a plan like this, then we need you to go ahead, enroll. It's one time, and then we give you a proposed plan. And we also tweak it if something changes for you. All right. When something changes for you, perhaps your mortgage got paid off by grandma or ma, right? Or your brother or your sister or someone. Guess what? Hey, it's gone, right? So let's go ahead and take that out. And then we'll give you even another upgraded proposed plan for you. And we'll show you the difference between the bank's plan and the proposed plan, the velocity plan for you. All right. We don't want you being like John. Okay. There's a million Johns in the world, so he's anonymous, right? But he's on a 50-year plan. And it hurts. It hurts me to say that. And it hurts me to know that he could do so much more with his money that he's making. He's making great money. He's a very responsible individual. But for some reason, up here, all right? And that's why we're doing this on a weekend. We don't usually come to you live on a weekend, man. But I woke up this morning and I said, I've got to tell them, I've got to show them how simple it is to make sure that you're not paying more than you should, and that you're actually getting the money out of your loan, that you're getting the money out of your line of credit, that you're getting the capital that you need when you need it. Okay? So folks, if you're having trouble with the velocity banking, if you're having trouble with your finances and managing that, why not go ahead and reach out? Okay? Reach out. That's the website right there. You can reach out as well in the description link. If you want to talk to me, go over the numbers. We'll go ahead and give you a plan, and we'll show you how to do the velocity banking correctly and soberly, right? So that now you can teach others to do the velocity banking method as well. Okay? It's not magic. It is math. And it takes a little bit of math. It does take a little bit of math, okay? Not too much. We did a little bit of math right now, and guess what? They've got calculators now. So let's go ahead and go over, hey, CJ, I don't know which loans to pay, okay? Well, what about that question? If you don't know which loans to pay, like I keep saying, please don't take my word for it. You know, I was in Phoenix the other day, and man, I was a little nervous. I really was, because it was nighttime. I think it was like 11 at night. I was going up to my room because I had a speaking event, and these three guys, man, they were in the elevator, and they said, "Hey, man, you look like LeVar Burton." And I was like, "Oh, man." And I think I said something like, "Don't take my word for it." Ha ha ha. You know, to make the whole situation light, because, 11 at night in Phoenix, you never know. But there were some good dudes. It was all good and everything. So we all went to bed and we slept well. So look, if you have multiple loans, right? What then? Well, then you want to take this through a calculator known as the CFI method. Okay, let's go ahead and write that out here. CFI. Okay, and it stands for cash flow index. That's the number that you need. You need the cash flow index number. How do you calculate that? Let's go ahead and show you how to calculate that. You're going to take the balance that you have on your loan, then you're going to divide it by the minimum monthly payment. Okay? As you take your balance and your minimum monthly payment, you're going to receive a number, and that number is called the cash flow index. Now, this number is going to be between 0, got to make sure you see it, all the way to 100. Absolutely. Okay, so let's go ahead and draw this bar here. And 100 is right here. And 0 is right here. 50 is somewhere in the middle. From 0 to 50, okay, is the danger zone. Okay, this is dangerous here. So that's why we call it the danger zone. Why is it dangerous? Because this is the loan that is sucking the most cash flow from you. That's why it's dangerous. And we want to get rid of those loans, and we call them ineffective loans. Shout out to Garrett Gunderson, my goodness. And shout out to Dale Clark. All right. Shout out to the whole Wealth Factory team just doing it up. Okay, over there, very patient, very kind. Them jokers know about insurance all over the place. Well, CJ, aren't you in insurance too? Yeah, man, but I don't mind giving them jokers a shout out. I got to give honor to whom honor is due. Okay, them jokers taught me. Okay, and I'm gonna go ahead and shove them some business as well because I believe in giving honor to whom honor is due. The man is just a legend. He's a legend. So check out his stuff, man, if you can. Denzel's too. Christy Van as well, man. Ricky, right? Man, I feel like I'm shouting out New Edition. All right, so look, danger is 0 to 50. 51 to 99, well, that's the caution zone, okay? In the caution zone, and of course, all of this is in the class, you also get a proposed plan as well. That's the class right there in that link. But the caution zone, 51 to 99. In the caution zone, what do? Well, in the caution zone, what you'll want to do is you want to either refinance, you'll either want to restructure the loan, or you're going to want to have a talk with your bank and say, listen, can we lower that interest rate? I've been a good boy, a good girl. I've been doing this, that, and the other. You can actually take my proposed plan and say, hey, here's what I plan on doing over the next couple months, next few months, next year, 24 months, whatever it is. You can take that in there to them and they'll be blown away and they'll be like, hey, this guy, this lady has it going on. Let's go ahead and lower that interest rate because they know what they're doing, okay? And so that's what you can do in the caution zone. However, and this is where many mortgages lie, you may be in the freedom zone, which is 100 and above, okay? 100 and above. If you find yourself in that zone of the freedom zone, then you don't have to worry about ever paying it off. Okay, fine. Okay, you do have to be concerned about paying it off, right? Man, but not as much as the caution and the danger zones, okay? We want to get out of the danger zones for sure. The caution zones, we can work with the banks on. And then the freedom zones, that's okay. And many mortgages lie in that zone, okay? We got the $250,000, you're only paying $1,200, $1,300 a month, $200,000 mortgages, $400,000 mortgages. That's in the freedom zone. You don't have to be concerned about that one as much. Now, the reason why I say that it's cash flow sucking is because these loans that are in this area, the inefficient loans versus the efficient loans, when we're talking about inefficient loans, we're talking about inefficient in regards to how much you're getting and then how much you have to pay each month, okay? So that's like $10,000, right? $10,000 balance, and then your minimum monthly payment is like $1,000 or $1,200 a month, right? Versus having a $10,000 balance and your minimum monthly payment is $500 a month or $100 a month. Well, that's an efficient loan. We like that. Why? Because it's giving us more cash flow relative to what we received. Does that make sense? Kind of like the $200,000 mortgage, right? That's why it is on the freedom line, because you got $200,000. Now I want you to look at this. You got $200,000 like this, okay? But you're only paying $1,200 a month for $200,000 that you got to pay back, right? Boy, we could do a whole class on mortgages. Because I heard somebody say, pay what back? Exactly. But I digress. That is another class. And you probably already know what I'm talking about. So that's what that is. There is a way to pay off debt using a credit card. Sure is. Sure is. Absolutely. And you know how you do it? You make sure that how much you have, how much you can take out, you place towards the principal. Because when you place it towards the principal, it'll actually decrease the interest that you owe. That's why we're called interest cancellation specialists. All right. So we have the cash flow index method. This, you may want to write this down. Okay. You may want to write this down. Loan balance divided by the minimum monthly payment. That's where you get your cash flow index number. Why is the cash flow index number something that you want? Because that's going to help you prioritize your loans. 1, 2, 3. The lower the number, okay, the higher priority of you needing to pay that off. Okay, so let's say you have a 25 loan and you have a cash flow index number of 55 loan. So you've got these two loans. Which one are you going to pay down first? You're going to want to focus on that 25. Why? Because it's in the danger zone. You got to get out of there. If it's between 0 and 50, you have to get out of here as quick as possible. As quick as possible. All right? Notary Automation Channel, man, it's good to see you again. Yes, and thank you, Ann, for that question. We're going to go ahead and answer that. Can I get, and we're going to illustrate that, absolutely. And of course, all of these are illustrated in the class right there. And you also have a proposed plan to go with it. All your numbers there, making sure that you pay everything off, not in 30 years, not in 50 years. Typically, it's between 5 to 10 years. It doesn't matter if you have a mortgage or not. Okay, let's go ahead and answer this one first. Can I get a first-lien HELOC to satisfy my second position HELOC? My goodness, that's a great question. And guess what? Does anyone know the answer? To satisfy the second position HELOC. I'll do you one better than that. You can get a first-lien HELOC to satisfy your whole mortgage. How's that sound? It'll just satisfy everything. Yeah. And so let's go ahead and make sure that we're not leaving you out at all when it comes to that, okay? Let's give you the website there, Notary Automation Channel, okay? The website to that one is going to be bit.ly. So bit.ly /first-lien1. Go there, my friend. Absolutely. Get rid of those second lien HELOCs if it is not right for you. What is a first lien HELOC versus a second lien HELOC? We'll go ahead and make sure, because we want to answer Miss Ann's questions here. We want to show you just really quickly the difference between a second lien HELOC and a first lien HELOC. Okay, are you ready? Here we go. It's going to be a quick illustration here. Okay, if you're looking at a second lien HELOC versus a first lien HELOC, okay, here it is. This is one of the most apt examples of the difference between a first lien and a second lien HELOC. Which one has bigger access to capital, bigger access to credit? The first lien. That's actually why they call it, part of the reason why they call it the all-in-one HELOC. It'll give you more access to credit. With the second liens, it's typical to have $80,000 access to, which is fine. Okay, that's great. But with the first lien HELOCs, it's typical to have the 200, 300, right? Way more access to capital when you're talking about the first lien. So you want to go ahead and make sure that you schedule that appointment with us as well. Notary Automation Channel, please, so that you can get that first lien HELOC. Yes. Yes. Hey, man, thank you so much. That's it, man. That's what it's all about. And so let's go ahead and get back to your question. I wanted to go ahead and address that. Miss Ann, watch this. Okay. Is there a way to pay off debt using a credit card? With a credit card, okay, you're going to be talking about 1,000 access, right, to 2,000. Let's just say 2,000, right? When you're talking about a credit card, it does depend on the lines of credit, how much access they give you towards that line of credit. But with the credit card, I would venture to say that yes, you can, but they're going to be typically they're going to be less than the lines of credit. They're going to be less than the lines of credit, but that does not mean you cannot pay off your loans with a credit card. What do you do with, let's just say, the 2,000? Let's just say the $2,000, okay? $2,000 in lines of credit, right? In that credit card. So you got access to it. What are you going to do with it? Well, you're going to hammer away with the $2,000 away at that loan, right? Let's just say it's 10K. So now, right, the 10K has been turned into 8K. And then you just use your credit card as your checking account, right, with the income coming in and then going out until it's all filled up again, right? And then if you want to deploy that same $2,000 towards that 10K, you can do it. Now, why would you want to do that? Well, because you are going to be persuaded by the numbers in how to do that, okay? And why to do that. Because when you're talking about the $2,000, what is that $2,000 doing there anyway, right? Is it just sitting there? Especially if it's just sitting there, right? If it's just sitting there, then you have to realize that your money's not doing anything, and stagnant money is ruined money, right? Because of inflation. So we want to make sure that we keep this money moving so that the credit reporting agencies keep reporting good things about us. Hey, this lady is paying us back massively every month. But see, they don't know that you know a secret, that you pay your credit line or your credit card with part of or all of your checking account. And what do they do typically when they see someone like that? Do they give you a credit line increase? Do they increase the amount that you can take out to maybe 3,000, 4,000, depending on your line of credit? Do they do that? Absolutely. And so you're not only massively eliminating debt, you're also setting yourself up for success with more lines of credit. Because what we want to realize, folks, and I'm glad that you asked that question, Miss Ann, you brought a revelation to me right now. Watch this, folks. This is what you're supposed to be using a line of credit for. Perhaps someone can say it already. Perhaps someone can say it while I'm erasing this board here. What are you supposed to be using your line of credit for? What is it typically supposed to be used for? There you go. Perfect. And so what we want to do, okay, is make sure that we're using it for assets. That we use our line of credit for assets. Now, why would that be? Because when you're using your line of credit for assets, you're setting yourself up for success. Does that make sense? Instead of placing your money towards something that will go to someone else, like the bank, okay? And it's great that you're paying that off. I'm very proud of every one of you, okay? You got brains, you got intelligence, okay? You have intelligence and you have the audacity to pay off your loans in a creative way. And that's good. But what the lines of credit are supposed to, that's right, Notary Automation Channel, build assets. They're supposed to be used for assets, not to consume, not liabilities. Okay? Because liabilities, what is the difference between liabilities and assets? I know everybody here knows, but maybe I can submit this for your consideration. Liabilities makes them rich, while assets make you rich. So now you're placing that line of credit towards a principal, right? But it's your apartment building. Now you're placing that line of credit, okay? And it's a principal payment. I mean, you're taking the $10,000, $12,000 from your line of credit, and now you're placing it towards this property that's yours, but now it's cash flowing. That's a property that you own now. And when you have those tenants in there in that apartment building, in that fix and flip, right? In that company, in that enterprise, you have that cash flow coming back to you. Does that make sense? And where does that cash flow go? Can it go back to the line of credit? Can you do the same thing over and over again? This reminds me of yoga, right? We want to do that. That's how we want to live life, guys. We want to live life in a cycle, just like that. Pay, borrow, pay, borrow. But instead of us paying, let's have somebody else pay it. Is that okay? And instead of us paying it, why can't we have businesses, right? Why can't we have the tenants pay our bills? Why can't we have the tenants pay our cars? We're doing them a service. And of course, we don't think of them as tenants. You know what I mean? They are people. They're not just tenants. Okay. Hey, I like my friend and I have the same mentality. Renting is great, right? But when you have a rental, man, that's even better. Okay. So that's what I mean. And AJ 416, that's what I meant. Audit your grandma. That's what I meant by assets. Liabilities make them rich, the banks. Assets make you rich, right? They give you financial freedom. And of course, only you can define what financial freedom means to you, okay? And look, if you're struggling with a plan, you don't have one yet, man, I'd love to help you out. This is the website to go to, bit.ly/Velban2. And if you need a first lien, an all-in-one, if you will, HELOC, go ahead and go to this one. You actually get a special listening rights because you're my viewers. That's the link to go to there. Okay, bit.ly/First-Lien1. Man, I hope I fed you some good news here. I made sure that your loans are going to be paid off. And what I want you to do, I want to see you inside that class. I want to see you learning things that you've never learned before. Because we do a deep dive into velocity banking so that not only you have it, but that you do it. Okay? Because we give you a proposed plan as well. We show you what the bank wants for you, and then we show you what we want for you with your very own velocity banking plan. Folks, let me know what you thought about this. We're going to be doing this more often. Thank you so much to everyone that tuned in. We appreciate every single one of you. I want you to watch this over, right? If you got, a little inside of the middle of it, I want you to watch it over. Let's go ahead and make sure that we're doing some deep dive, because we did a deep dive today. We answered some questions, and we want you to be knowledgeable on how to pay off your loans. I talked to a young man yesterday. Named by the name of Don. He said, my goodness, I got this plan. And CJ, thank you so much for your help. That's what it is all about. We are living in interesting times, but it is the most exciting time because velocity banking still works. We'll see you soon, and we will see you on the inside. God bless everyone, and have a great weekend.